Hey, Patrick Findaro here, co-founder at Vetted Biz. Excited to be on with Charlie Jebran, the CPA, specifically focused on the franchise business niche. Charlie, thanks for joining today.
Patrick, it's a real pleasure to be with you today. I can't thank you enough.
So maybe you could start with telling the listeners a little bit about your professional experience. I understand it's quite different than the typical CPA.
Nah, it certainly is. I've always had an interest in business. It goes back, long in the past. And when I went to college, I said the easiest way to be part of the business environment is to become a CPA. So that's what I studied, and I came out of school with that degree, and worked for a big firm. For a couple years, worked for another couple firms before I launched my own firm in 2003. But ironically, the in 2003 was also the same time that along with a friend, started searching for a franchise. Ended up, owning two Dunkin' Donuts and a Baskin Robbins included. So, kind of a storied past, in that I'm not your typical CPA, in that I actually know how to run a business because I've had to do the things that the business owners that I give advice to often have to do.
Where was the Dunkin' Donuts located?
We had two. One was in Ambler, Pennsylvania, which is about 10 miles outside of Philadelphia, and the other was in Lansdale, Pennsylvania, which about 15 miles outside of Philadelphia.
And I know I don't want to get too off the track because the focus of our conversation is more on the accounting side, bookkeeping, year-end tax planning.
Sure.
But from what I understand, what I've studied, Dunkin' Donuts is quite profitable, and even in the past, like I think when you were running it, the profit margin was even higher than it is now in 2022.
Mm-hmm.
But Baskin Robbins, the average unit volume is not as high, and it's just a very different business than Dunkin' Donuts. Was there a reason why you opened up the Baskin Robbins as well, or was it something that they were kind of pushing to get the franchisees to open up?
Yeah, that's a very good question. It's kind of interesting because of the fact that a freestanding Baskin in California or other warm climates did very, very well. And it's a very rich ice cream. So, unlike the Ritas and the Dairy Queens that have a lot of air and so forth in it, the milk fat, very good for your diet, is high. But in California, where you have the climate and so forth that works, it's conducive with the product. Stores did very, very well. Here on the East Coast, they wanted to try to say, well, if somebody loves Dunkin' Donuts, then they certainly are going to be coming back for the Baskin because it's a quality ice cream. It's a dessert. And that didn't quite work out as well. And you're absolutely correct. The profit margin was on the lower side. The Dunkins had to staff an extra person at night to take care of the Baskin side. So, for a lot of franchisees weren't that thrilled. So as you saw the people go through their remodels, you often saw the Baskins kind of fall by the wayside.
We've seen that with Yum Brands, Taco Bell, where they rolled out Taco Bell Express, and like at its peak, I think it had like 300, 350 units. And it's like every year they're like closing like 50, 60, 70, where it seems like a better approach is like start small, where the franchisor has this idea and like test it out with like a couple corporate locations before rolling it out with 100 plus locations.
You would think that would be the smartest thing to do, right?
And tell me, how did you juggle running two Dunkin' Donuts together with CPA? Or do you take a break from the public accounting, from the accounting work?
No, I never took a break. In fact, both stores opened in the midst of tax season. I think right around February 15th, and it was hard. Plus I had two young kids. My partner had
That's what I was going to ask. So how did you handle that side?
three young kids. I brought a lot of donuts home at night, so they were thrilled. But no, you know what? It goes back to organization and being able to have a good work ethic. I was fortunate with my parents and the jobs I had early on that the work ethic that was instilled with me basically allowed me to kind of work through all those things. I had a very forgiving wife who looked forward to the rewards of having ownership. And honestly, as we got into it and, got the second one going, and things just got a little bit easier, because that's what happens. You learn and struggle with your first one. And with the second one, then you kind of know sort of what to expect, how to do it, and you're able to share a lot of the people between the two units and such. But kind of doing tax season and such, it was difficult, but I worked through it. Had had one employee who worked with me, and that worked out okay. So yeah, worked hard. That was the biggest thing.
And was it a successful exit? Like, I guess, did you recoup your money and more when it came time to sell?
Yes, absolutely.
I love it.
You get into these things, and that's one of the parts, as I think I mentioned to you, previously, that I'm writing a book. But that's the whole thing. We ultimately sold it in 2012. So we had one for 7 years, the other for 5 years, and one of the local franchisees came and offered us a deal we couldn't refuse, as they say, and yeah, so we were thrilled. So it was sort of time, because with every franchise, that at least a food franchise, typically at 10 years you have to remodel. So the one was approaching the remodel time, and the
And
other
we're
one was
talking what? 200, 300K
sure.
expense?
Yeah, yeah. Basically, because you basically go through and redo all the machines, and redo the insides to what's now the current model, and things. So, we just knew, okay, we were getting down to a good point, and there is a value, just like anything else, in the amount of time left in your franchise period. So, for Dunkin', the franchise period was 20 years. So,
That's right.
you
Yeah,
know,
usually we see 10 years, but you have some that are 5, 10,
yeah.
20, 30 even.
And that's one thing I say in the book, is you really got to look at that, because some people say, "Hey, okay, I can, it's $25,000 to get into a Rita's. That's a good deal." And I think Rita's currently is it's 8 years. Well, versus 50 or 60,000 to a Dunkin' that is a 20-year term. That's a much better chance to make more money.
Yeah, and I think also it's like, so you have the renewing the term and the expense of what you're going to have to do to get it up to the standard that that brand has. And if there's 50 locations, it's going to be different, and they're going to be probably
Mhm.
looser than if it's 1,000+ location brand.
Sure.
But another consideration is when it comes time to sell, like, what's a transfer fee like? Like,
Yeah.
you have some franchisors where they bake in the transfer fee.
Hmm.
That's coming out of your pocket, essentially, where you're going to have to pay, you're going to get $20,000, $30,000, $40,000 less.
Hmm.
And sometimes they also bake in legal expenses, accounting expenses. So that can be, depending on the size of the business. And I think your business or Dunkin' Donuts, it's not as important, but a Rita's Ice, you're selling it for 300K, 200K, and you have this 60K transaction cost, and it's like, shoot, what was this? Was
Yeah,
this
what to
worth
do?
it?
Now, it's true, because you have to remember, you want to say that the franchisor is your friend, and to a certain extent they are, but they're in it for the long haul, and they're in it for the money. Each month when they get their royalties and the ad fees and so forth to promote, they want to be compensated at the end. And to your point, if you want to transfer. Ownership even within, like, maybe I don't want to sell it, but I'm going to add a partner to it. There's rules and regulations that surround that,
And
and there's
depending
fees.
how much the partner has, what percentage that you're gonna have
Yeah.
to like get him
Mhm.
trained for thousands of dollars.
Exactly. Yep. Yeah, nothing's free.
And so you basically sold your Dunkin' Donuts to a franchisee in an adjacent territory.
Yes.
That seems like the
Yes.
easiest. We
Oh,
get
yeah.
approached all the time. Hey, I want to sell my franchise. Well, I said, consider talking to the franchisor and then
Mhm.
franchisees. And then you can go to a business broker, but expect taking 6 months to sell the business.
Plus another percence. I mean,
And yeah,
there's
10% clip.
usually 10, even 12 in some cases. So you're losing that. So now you got your transfer fees we talked about, plus the broker's fees. You walk away with nothing. Not really
Yeah,
nothing, but
a big item that we do at Vetted Biz, and we haven't rolled it out yet online, but we calculate the resale value. So surprisingly, there's a lot of franchises where the sweat equity is not built in, where the investments say 200K, like a Subway, for example, 350K to open, and they're selling for like 180, 200.
right.
So like, why would you open up a Subway if the resales are for less, and you're not only is your sweat equity not being priced in to when you exit, but it's actually going to be sold at a monetary loss.
Yeah, no, that's a great statement, because of the fact, everybody wants to get into these things, and right away they think they're going to make tons of money, and it's hard, and but you have to do your research, because there's things like that, even from a possible chance to expand. I think Subway had, it was a story I know from a franchisee that I talked to, that he wanted to expand, but the master franchisor said, no. So he was stuck owning his three, and he really had the money, he had the wherewithal, the knowledge, everything, but it was almost a personality game. And
And
some
then
people,
like the strategic buyers, you like talking to franchisees that have had a successful exit, a lot of it has been, yeah, franchisee in adjacent territory, or maybe selling to a private equity firm where you've developed 5 locations, you have the development rights for another 5,
yep.
and you can probably consolidate more in the area. So instead of getting like a 4x, 5x EBITDA multiple, could be more like 7, 8x.
The thing, Patrick, that people don't really know is really how to sell their business. I
Yeah.
mean, that's, there's a variety of ways. I mean, there's ways to value the business, but, synergy is the key. And I think you touched on, if I sold to somebody who is an adjacent franchisee, obviously he knows the market, he knows the geography that you're in. He is best suited for that. And that goes for any business, realistically. I mean, just because you have, whatever you want to call it, XYZ business,
Yeah.
when you look to sell it, maybe just putting it on the market and selling it to Mr. Smith down the street may be the good thing, but you really have to analyze it because there are so many opportunities to align with another group that possibly could afford you a lot more. You said 7 times, 10 times, it could be a lot more. And there was a story that I read about a payroll company that basically catered to household employees, and the person thought that they could build the business up, and they did, and it was worth a decent amount of money. But when they started to really kind of put together the value, they said, well, what happens if we affiliate with somebody else who can utilize our list of people, and all of a sudden, instead of getting what it was, I'm going to say, like a $9 million fee, they sold it for $90 million, because the other people could, or the other group who purchased them, could actually access and get so much more money out of it that the business was valued a lot higher than what was originally expected.
Yeah, and just thinking out loud, it seems like there's kind of a scale where you have like the individual financial buyer where he has 500K to maybe 5 million to invest, and it's all about the money that he's going to be making and the cash flow of the business, which isn't going to be as desirable as a private equity fund that's really going to be building this up, or a franchisee that's really going to be building this up. But then even better, and taking it, pausing on the franchise space, is just a multinational. Yeah. And they're willing to pay 20 to 30x EBITDA because they have that one product, and they're going to sell the hell out of it across their distribution channel.
For sure. That's why you really have to analyze what you have. Yeah, every business is, I always saying that I'm so frustrated in times because I hear some, not clients, but people say, yeah, he closed his doors. I said, well, did he sell it? No, he just closed it. And every business has a value.
So it's December 8th. We got to definitely get this pushed out like next week, because I want to talk about year-end tax planning. So we have a lot of business owners, franchise owners that listen into our YouTube channel, podcast. Many of them are making 100K, 200K. We have some that are making over $1 million. What should they be thinking about rounding out the year to mitigate the taxes that they're going to have to pay for the 2022 tax year?
Yeah, at this time of year, I mean, tax planning is essential to the business and so forth. So, a couple of things. With the Tax Act of 2018, sort of made things a little harder, because it kind of limited many areas that used to be a little more flexible for business owners and personal people. But in reality, look for buying equipment. Because that can be written off immediately. So if there's a piece of equipment that you need, certainly look to add that to your asset list, and get it done by December 31st, because that can obviously it comes right off the bottom line, which is fantastic. So you can save a nice tax there. The other thing that's kind of fun is depending upon the size of your organization, making sure you have a proper retirement plan. Everybody hears about the standard simple plans and the 401k plans, but there's one out there that's kind of interesting called a cash balance plan, which many of your financial planners will know exactly what to do with it. But in that one, the owners, typically are the guys who are making the most money within the organization. And when you combine that with what the rest of the employees are making, often they can put a lot of money aside. It's a deduction, but the majority of the money goes to the owner.
And
So
what are we
that
talking? 50,000, 60,000?
it all depends on the size. But I will tell you a real life example. The first year, cash balance plan for an organization, they were making about I think net income of about $700,000, and the W-2 for the owner was roughly about 170. He had 15 employees, and they ranged in age, and they ranged in the amount of money they were making, upwards of about top about 70 or 80,000 bucks. And I believe the first year he was able to put approximately $180,000 into the plan, of which he got 160.
Okay, so it's
So,
significant.
yeah, so think of that. So, you give a little perk to your employees, but, wrote off $180,000, which, roughly saved him, 36 to $42,000, plus state tax,
And then
depending
thinking
on.
about compounding, I mean, in 20 years, that $30,000 is probably worth $1 million.
It could be, yeah. So I love when some nights I can't fall asleep. So, and this is
It's like
the number guy in me.
1.1 times the 30,000 times 1.1, and it compounds fast.
There's that way, but also I do the rule of 72, which is, you take your interest rate, divide it into 72, and that's the number of years it takes to double your money.
Ah, smart.
Yeah, so that's a fun one.
So besides the cash plus, can you think of any other items that entrepreneurs should be thinking about, or maybe going into 2023, things that you can be doing throughout the year to mitigate your the tax hit?
Yeah, no, I think it's important to always look at opportunities to. Well, I think one of the things you do is you try to look at how you can limit your taxes. But ultimately, what you want to do is you want to maximize your deductions and while making the money. So one time years ago, somebody came to me and they said, Charlie, I'm gonna buy this truck. I said, that's great, and he said, it's $60,000. That's great, and he said, I'm gonna save a lot of tax. I said, absolutely, that's true. I said, do you need the truck? He said, no. So it's like, don't spend the money just because it's going to
You
save
need
you
to make
tax.
business sense.
Business decisions, and that's what a lot of people unfortunately make the wrong decision. They try to save tax, but don't realize that they actually are just, costing them cash. So, I mean, those are really the primary things that people should focus on. The 401k is, kind of maximizing your cash flow at the end of the year. I mean, some people will say they obviously the stores, food places do not have the opportunity to because they're taking cash and credit cards. But at the end of the year, some other type service businesses may, hold checks for a period of time, and then
Sure.
make a deposit January 2nd. So that's obviously a good thing. And then if you're a cash basis, you can certainly write out some checks to pay for expenses, but maybe hold them until just the last minute, December 31st before you drop them in the mail. So that helps your cash flow. So you're getting the expense early and maybe deferring that deposit until a little bit later.
Yeah, and you mean because you never know what the next year has in store. So
Yeah.
it's like figuring out for this year and mitigating, I guess, whatever you're gonna have to pay in taxes for
Sure.
this year, 2022.
Ultimately, it's going to come back to you'll catch up. When you
Yeah,
go to
of
close the
course.
business, you won't have
You-
any expenses. You'll have all this cash. but that's a good problem to have. I mean, that's the whole I think. It's tax minimization is the best the thing that we do for the clients, and kind of project out to where we think you're going to be, and just trying to see what the client needs to be successful.
And with your skill set, and I know you work with all different types of clients, but you continue to go back to franchises and working with multi-unit franchisees. Tell me why franchises? And I know you had that experience with Dunkin' Donuts, but you could be serving all different types of industries, and why focus on franchises?
That's a good question. We do have a variety of clients, but the franchise environment is one I just really get really excited about. I mean, I had a new client call about a year and a half ago, and they were just talking about getting into a franchise, and for the about 15 minutes, I just was going on, and my heartbeat was getting excited because it's just a passion that I have. One of the things I say is when you go to choose a franchise, find a passion, and I think to a certain extent, running a franchise and assisting someone to be successful in a franchise, I found my passion. Accounting's fun, and I love to see a client succeed without a doubt. And I tell them at my age now, it's all about education.
Yeah.
But now when you really delve into something that you have in-depth knowledge about. As I said with the book, being able to say, "Hey, I wrote a book." Well, now it sort of makes me, somewhat of an expert. That's exciting, and I can feel my heartbeat, going up right now just talking about that. So yeah, I think I can serve anybody and give them a lot of knowledge, but just the ability to draw upon the things I learned while being in a franchise will give me the ability to teach them what they can expect, and hopefully knock off some of the things that they maybe going to run into some trouble. If they don't run into that trouble, then that's a good thing.
How can you help prospective franchisees? Someone that's maybe spoken to a few franchisors, maybe they're working with a franchise broker. How can you help them with the financing or due diligence? How can you help prospective franchisees?
A variety of ways. One of the things, as I said, is that since I lived through negotiating leases and working with contractors, looking at a variety of franchises before we got into the one that we chose. I think I can sort of lay down some of the things, the pitfalls. Obviously, from a break-even point, I mean that's important. A lot of times you say, "Hey, this is a great location, and this is the numbers I think we can do." But if the rent is going to be, in fact, I had somebody a couple months ago, and the rent was astronomical, and I said, "There's no way you're going to be successful because that rent is only going to go up from there." Those are the questions, and those are the things that I can help with. So, from a financing standpoint, that you get into a new business, and I don't care if you had a great relationship with the bank down the street for years, and there used to be the good old boy network. I lent to my father, and I lent to his father, and
Basically,
the banks would do
which
that.
is,
The
yeah.
banks don't do that anymore. So now it comes down to, hey, Charlie has X dollars to invest. Yeah, but how? I don't want to give you a loan
You
unless
have
it's
to
going to be
sell it to the
successful.
bank.
Yeah. So what happens is that 90% of the time, first time franchisees are going to have to go through SBA, and the SBA has a package that they want. So one of the things I can help you with is put that package together to present to the SBA, so they now are not going to have any questions, or at least can go through the package to say, all right, well, this looks like you're going to be successful based on your projections, the amount of money down. The other part too is kind of interesting too, is they always want your initial investment, just like buying a house where you have to put 5%, 10%, 20%. Obviously, is preferable. SBA wants that. Well, how do you work through that? So, a lot of people miss out on the fact that, well, I did do some training, or I did go down to the business broker. Well, those are expenses. Those are investments now that I can apply to that 20%. So those are the things that you people lose, from a tax standpoint, because they'd say, oh, yeah, I didn't include that. That's a true write-off that you will be able to take at a point. But it's also now I may not have to come out with the direct cash to go against the percentage down that the SBA is looking for.
That's very cool. I've never thought about it that way. But basically, your expenses you've already spent towards the equity contribution that the bank underwriting the 7A loan is the 7A SBA loan is looking for.
Absolutely.
And then how about with franchisors? Do you work with any franchise brands and doing the yearly audits, or supporting both the franchisor and the franchisee in the same brand?
Presently, we only work with franchisees. We're looking to try to work with the franchisors. We've developed, I'll call it a benchmarking type of software that picks out some anomalies that may occur. And the way it works is you kind of plug in all of the net stores in your network. So ideally, you can do that at the franchisee level, but if you were to actually look at that and put it in at the franchisor level, now the franchisor has the ability to perhaps make a lot more money because it's picking up on some of the things that are just not perfect within a franchise operation. So we're looking to hopefully work in tandem with both those groups.
And how about like on an ongoing basis? I meet franchisees that do their own bookkeeping, and other ones that outsource it, or even have a full-time person or two doing bookkeeping. How do you work with franchisees on an ongoing basis, including with bookkeeping?
Yeah, a variety of ways. I mean, there's some that I just do the tax returns because they are big enough that they have a back room. But quite honestly, we do from the franchisee standpoint to the non-franchises that we work with. We have a prolific bookkeeping group that works remote. And, one of my catchphrases is always, surround yourself with people who know what you're doing. So that allows you to do what you do best. You don't necessarily want to be doing the books. You have to know what's in the books and be able to understand your ratios and things like that, because ultimately, there's decisions that have to be made for your expansion based on how your numbers are looking. It's not just about what you have in the bank, but ultimately we can do all the bookkeeping, file your sales tax returns. We can file your royalty statements on a monthly basis. Pretty much act as your entire controller in the back room without me being in the back room. And then the other part that we like to offer too is the fact that with that benchmarking software that we have, meet on a quarterly basis and kind of give them some pointers, some things to target during the next quarter. So when we meet, we can say, okay, how'd you do here? Because, quite frankly, the franchisor they want their money, as we mentioned. The franchisee is sort of on their own island. So now the only people they have to look, for some advice is either another franchisee who is in the same, area and so forth. And a lot of guys are always willing to help, but it's still not your store. So, having a fresh set of eyes, which, we often are those eyes, it makes it a little bit easier for them to kind of talk to us, almost like a mastermind leader. And ultimately, what we'd like to have is like a mastermind group where we can put together a whole bunch of franchisees to kind of talk about common things. Right now, what's the biggest thing about the industry? It's hiring. How do you get people to work? So they can talk about best practices. Sharing some things that maybe were successful and such.
I'm surprised more accounting firms don't do that, because they know their clients' needs so well, and they're in a unique position to introduce different business owners, where you are a trusted advisor,
Yeah.
as are many lawyers, for example, where if they make an introduction and connection, both parties are going to give the full attention, or a lot of attention, to that introduction being made.
That's exactly why we're trying to move into this field, because I think it is something that is very beneficial to the franchise community, because they can really learn. There's mastermind groups for accountants. I can imagine those groups getting together, accounting jokes and things. But we do learn a lot from each other and what they do, what we do, and how to do it best. So same thing is very true with the franchise community, because there's so many commonalities that they can definitely learn some things.
Well, Charlie, I've learned a lot today. I'm sure those listening in as well. Is there any last thoughts you want to leave with prospective business owners, even current business owners that are listening in or watching on YouTube today?
Well, I think the biggest thing is, if you're choosing a franchise, I used that word passion before. Find something you're truly interested in. Something that you can do long term, but something that's just going to bring you joy, because you're buying yourself a job. You're buying yourself a proven method, though. You used the subway as an example earlier, and if you go into a subway, it doesn't matter where you go. They carry the knife the same way. They cut their bread the same way. They bake their bread the same way, and there's a reason for that. It's a proven success to present a product that's done properly. Same thing is true for we'll say a lawn care franchise. It's like you may have no idea. I can go to Home Depot or one of those stores and buy my fertilizer, but you don't know exactly how to apply it. Well, now you have the knowledge. So now you have a combination of, I want to own my own business. I'm going to choose the right one. I have passion, and they're going to teach me how to do it. And I get to do what I like doing, every day. So that's the key. So if you look forward and pick those type things as you're going through I think you'll do well. And just keep track of your numbers. That's the accountant in me, because too many clients come to me and say, I don't understand my numbers, yet they got into a business, and that's hard. So that's why I said, education is key, but being able to track to see it's where your numbers really are and how you're doing will make your life a lot better, and ultimately you'll be successful.
Over the last few years working with your large breadth of clients, any industries that really piqued your interest, where you were kind of surprised and like, oh wow, the financial numbers make a lot of sense here?
I always loved, believe it or not, Orange Theory. I thought was a pretty cool one. I don't know if you ever work out one of those, but it's an intense
Definitely a
workout. Yeah.
recurring revenue business
Yeah.
model.
Oh yeah, no, it's great. So they piqued my interest. The massage places like Massage Lux, and I think it was a Massage or Hand and Stone. Those are very profitable as well. But again, just because one's profitable doesn't mean the nails is going to be. It's all based on location and what the geography looks like. So. You have to be careful.
Well, Charlie, thanks so much for joining, and let us know when you release your book, and we'll be sure to add that into the description of this video.
Now, thanks again for having me. It's been a great day. I appreciate it.
Thanks, Charlie.
You're welcome.